You know, for our whole lives, we've been told to save for retirement in a 401k or an IRA. It's like the golden rule of personal finance, right? But what if the very accounts that are supposed to secure your future are actually a trap? Today, we're going to dig into the hidden dangers of these tax-deferred retirement accounts and, more importantly, how you can sidestep them.
I mean, we've all heard the advice a million times. Put money in your 401k, get that sweet employer match, grab the tax break, and just let it grow. It's the absolute cornerstone of the American dream of a comfortable retirement. But what if there's a catch? What if that giant nest egg you've spent decades building could actually trigger a whole cascade of financial headaches you never, ever saw coming? It's a pretty wild thought, but it's one we really need to look at closely.
A death trap. Wow. I mean, that's a really strong phrase from our source material, but it perfectly highlights a huge issue that catches even the most careful savers completely off guard. So let's break down what this trap actually is and how it could mess with your financial future.
Okay, first things first, just a quick refresher so we're all on the same page. We're talking about tax-deferred accounts, your traditional IRAs and 401ks. You get a tax break now, your money grows without getting taxed year after year, but, and this is the big but, you pay regular old income tax when you take it out in retirement. Seems simple enough, but the devil is absolutely in the details.
So, how in the world does your biggest asset turn into your biggest liability? Well, it all comes down to a few hidden risks that, let's be honest, most of us just don't think about while we're busy working and saving.
We're going to break down these 5 big ones. And what you'll see is that each one kind of builds on the last, creating this ripple effect of financial problems that can seriously chip away at what you've saved. This right here is the absolute core of the problem. Think about it. If you sell a stock you've owned for a while in a normal brokerage account, you pay the lower long-term capital gains rate, often 15%, maybe 20%. But when you pull money from your traditional 401k, you're paying your ordinary income tax rate. That could be 24%, 32%, or even higher. That is a huge difference, and it's where this whole trap gets started.
Now let's watch how this one simple tax rule creates this massive, costly domino effect. And it all kicks off with a single number, an age, that triggers a rule that can totally change your financial picture in retirement.
This is the magic number. The moment you hit age 73, the IRS basically steps in and says, all right, time's up. You have to start taking money out of those accounts, whether you actually want to or not. This is what's known as a required minimum distribution, or RMD.
And that is such a critical point. A lot of people plan to live on other things, like a pension or Social Security, and just let their nest egg keep growing. But RMDs? Well, they take that choice right out of your hands. The government has been waiting patiently for its tax revenue on all that growth, and these forced withdrawals are how they finally collect.
And this chart really shows the problem in action. So let's say you've got about $50,000 a year coming in from Social Security and maybe a small pension. You're doing okay. But then, bam, you're forced to take out a $30,000 RMD. All of a sudden, your taxable income jumps to $80,000, and that could easily push you into a whole new higher tax bracket. The irony is, you could end up paying more in taxes when you're retired than you did when you were working.
Oh, but it doesn't stop there. That extra income from your RMD can suddenly make a huge chunk of your Social Security benefits taxable too. Depending on your total income, up to 85% of the Social Security benefits you thought you could count on could now be subject to income tax. Talk about a nasty surprise.
And the hits just keep on coming. That higher income can also trigger something called IRMA. It stands for Income-Related Monthly Adjustment Amount. It's basically a fancy term for a surcharge on your Medicare premiums. If your income crosses certain lines, the government just says you have to pay more for the exact same health coverage. We're talking about hundreds or even thousands of extra dollars a year.
And finally, let's talk about the money you want to leave behind. When you pass a traditional IRA or 401k to your kids, they don't get that money tax-free. No way. They have to pay income tax on every single dollar they take out. And to make it even worse, a new rule forces most of them to drain the entire account within 10 years. This can create an enormous tax bill for them, right in the middle of their own highest-earning years.
Okay, so that's the death trap in a nutshell. I know, it's a lot to take in, it's pretty bleak, but don't worry because this is not a hopeless situation. There are absolutely ways to avoid it. The whole key is being proactive. So let's look at some really powerful strategies that can help you keep more of your own money.
Now check this out. This slide lays out the alternatives so clearly. the Roth IRA. It's basically the mirror image of a traditional IRA. You pay the taxes on your contributions up front, but then the growth and, this is the game changer, the withdrawals in retirement are 100% tax-free. And just as important, there are no RMDs for you, the original owner. You are back in control.
And that leads us to maybe the single most powerful tool for escaping this trap, the Roth conversion. This is where you intentionally move money from your traditional IRA or 401k over to a Roth IRA. Now, yes, you do have to pay income taxes today on whatever amount you convert, but in exchange for that, that money can now grow and be withdrawn completely tax-free forever. It's all about choosing to pay taxes on your terms, not waiting for the IRS to dictate them to you.
So, what happens if your income is too high and the rules say you can't contribute directly to a Roth? Well, there's a strategy for that too. It's often called the backdoor Roth IRA. It's a simple two-step. First, you put money into a traditional IRA, but you don't take a tax deduction for it. Then, you immediately convert that money into a Roth IRA. It's a completely legal way for higher earners to get money into that amazing tax-free bucket.
And there are other great tools in the toolbox. If you're charitably inclined, a qualified charitable distribution lets you send your RMDs straight to a charity. You satisfy the IRS rule, but the money never hits your income, so you don't pay tax on it. You can also use withdrawals to fund a health savings account, or HSA, which has this incredible triple tax advantage. And for some folks, if your 401k plan allows it, there's something called the Mega Backdoor Roth, which can be a real game changer.
So, what's the big takeaway from all this? It really comes down to one idea: tax diversification. I mean, think about it. You would never put all your money into a single stock, right? So why would you put all your retirement savings into a single type of tax account? Having a healthy mix of tax-deferred accounts, tax-free Roth accounts, and even regular taxable accounts, that gives you flexibility. It gives you control.
This quote just nails it. The default path, just letting that big tax-deferred account grow and grow without a plan, is often the most expensive path you can take. Being proactive now is what's going to protect your wealth from a whole lot of unnecessary taxes later.
So, I'll leave you with this question. Is your retirement plan truly prepared for what could be a ticking tax time bomb? By understanding these risks and looking into strategies like Roth conversions, you can take back control of your financial future and make sure your retirement is everything you worked so incredibly hard for. Thanks for tuning in.